Thank you. It's, your point was one I was going to bring up myself. I'm Alan Fennick from Imperial College. My question really is to Louise about the development impact bonds, because we have been in discussion and a number of people have come and suggested that these bonds might be a good idea, whereby either governments or foundations or individuals would invest in the control of neglected tropical diseases, and that they would get a return on their money. And I may be a bit stupid, but I don't see how they're going to get a return on their money when the people that we're treating basically don't have any funding. They aren't going to be able to repay. We're going to improve their quality of life and their health, but the financial return, I'm not quite sure how it's going to come so that the investors can get their money back. I don't know if you could clarify that for me.
Of course. Yeah, of course. So apologies, I probably rushed through the diagram showing how development impact bonds are structured, but I guess our key observation, both the social impact and the development outcome bond, development space, is that actually there are stakeholders other than the direct beneficiaries themselves that value those outcomes. And so, for instance, in the Uganda sleeping sickness model, DFID would pay for the outcomes, DFID would pay for success. In other models that we're looking at, that's sometimes a charitable trust and foundation that is looking to put their money to work in a different way. But I think what we're finding is that both among, and when I am conscious in terms of picking up Raf's point on language, when I talk about donors, I tend to be talking about the DFIDs, the World Banks, the bilateral and multilateral donor agencies, rather than a kind of donor in a fundraising sense. You know, we see that there is a lot of interest within those institutions in doing what they do more effectively and more efficiently, and there is a lot of interest, I think, from them in paying for success and, if you like, devolving the service delivery and the delivery of those outcomes to people that are better positioned to define and build on how those are best delivered. So it isn't about, you know, farmers in rural Uganda kind of paying investors and saying, thank you for removing sleeping sickness. This is about, and it could sometimes be, you know, the country governments contribute to those too. In the social impact bond space, you know, we work with the Ministry of Justice, the Department for Work and Pensions, etc., who are paying for success. But it's you know, I guess taking a broader view around the social value of the outcomes that are delivered.
Yeah, a few more questions there.
Just a follow-up question. I was just trying to understand, I didn't quite get from your presentation what the added value is that your organisation brings in some respects, because donors like DFID and USAID are moving towards results-based payment. That's well established now within the sector. Cash on delivery is a kind of mode of operating that we're having to deal with. So what I didn't quite get, it's probably just me being stupid, but...
No, not at all. There are no stupid questions. I think you're right, and both in an international and a local context, donors are increasingly looking towards outcome-based contracts. I think one of our starting observations was that that can limit the market of service providers that can deliver against those contracts to those that either have assets of their own that they can use and put at risk to fund the service delivery up front, or who have access to that funding, sometimes in the form of debt, that it doesn't necessarily share the risk with them. So they might either use their own assets or take on debt to deliver programs and pay for the cost of implementation up front while they wait for the outcomes to be delivered and the payments to come through. The structures that we're developing in the impact bond space are looking to investors to take that risk. So service providers are being paid for their services up front by investors, and the investors are taking the risk on whether the outcomes are delivered or not. So donors, in the event of success, are paying back to investors. And what we're finding in the context that we're looking at is that really broadens the range of service providers that can consider participating in outcomes-based contracts. Beyond those that have kind of deep pockets or good access to finance themselves.
I think you were saying, but the reasons why DFID and local governments are prepared to pay is because you found models that actually are, you get more for the buck, if I can use more financial language, but you are finding a more cost-efficient and sustainable way of delivering the service. So having spent previously 100, just to get a figure, on a recurring basis, now you can get the same effect by using 80 because you are more focused on the outcomes and you're only sort of using that methodology.
Hi, Alex Dave from Meta. Apologies, my question is also for Louise, but I'd also like to chat to Bitpay afterwards. My question's twofold, really. Firstly, just on that same point, I know with the Peterborough prison bond, the rationale for the Ministry of Justice is to repay the investors a dividend based on how successful they are in reducing reoffending, because it's cheaper than kind of prosecuting and putting someone back in prison. So is a cost-benefit analysis always required for social impact bonds in terms of kind of assessing the cost saved? And then also my second question is about monitoring and evaluation, and obviously for this to work, a quite robust monitoring and evaluation kind of mechanism is required. Who pays for that?
Both good points. In terms of the cost-benefit analysis, I think it's true to say that in the social impact bond world, if you like, in the literature that is developing around that, a lot of the focus is on where this kind of structure can potentially deliver cost savings to government or donors. I think that is doubtless, and particularly was, I think, a few years ago when we first started in the social impact bond space, and there was an austerity climate in the UK where we were operating, was undoubtedly a kind of key consideration for the government stakeholders we were working with. I think what I have found exciting is that actually there are benefits that move beyond that, and we are finding increasingly stakeholders that are prepared to think about social value more broadly rather than just cost savings, and that's certainly, I think, my preference is to focus on thinking about the social value, an element of which might be some improved cost efficiencies. But, for instance, we did some work with GLA around homelessness a couple of years ago, and there isn't really a cost saving to government to bring homeless people off the streets and into housing, but there is, I think, a huge social benefit to that that would be fairly hard to disagree with. So I think what's exciting to me is that they're seeing these models increasingly as ways to deliver better outcomes, full stop, and that's a good way to go, irrespective of whether or not there are cashable cost savings. In relation to your point around monitoring and evaluation, you're right. In order for these contracts to work and in order for investors to be comfortable with them, there has to be really robust outcome measurement frameworks in place at the beginning. So everyone is clear about not just how you define success, but exactly how that will be measured and for whom. That's not a cheap thing to set up, but I think what we are finding very often is it helps in the operational delivery. That level of data enables us to flex, and service providers to flex and innovate and respond to what's working and what isn't working in their delivery process. But I think also actually governments are finding it useful because they're learning what works in a way and with a level of, I guess, insight that they didn't previously have. Their contracts weren't necessarily so tightly defined. It is a cost, and I think development impact bonds, social impact bonds aren't a solution to all problems. I think they work best at scale because there are fixed costs around measurement, fixed costs around contracting that actually mean that they're expensive at a small scale. But I think when there is potential, as I think there is in a lot of NTD and health areas, where impact depends on reaching scale, then actually this kind of approach could be very exciting.
Maybe I just add to that because Louise just touched on it. I mean, one of the challenges that I've certainly found in this venture philanthropy or impact investing field, and also my background is a financial industry, not a social industry, that we really constantly measure and work along two axes, really. One obviously is financial, because we do aim to support and invest in organizations that might probably are not financially sustainable yet when we invest, but very much aspire to become so, but as broad objectives do rank a social, or in our case, environmental objective, before that financial measure. So from the time when we start to engage with an organization to due diligence, to structure the investment, to then monitoring it, we're constantly working on really setting up frameworks for measurement, for monitoring, for reporting back to our investors, financial metrics, social metrics, or environmental metrics. And obviously they interact together, and there's an interplay between the two, and that's very interesting, but quite challenging. I guess the same is happening in the social impact bond field. Any other questions? There's one there, yeah, maybe.
I would like to add one aspect. We are also working on malaria, and in malaria we have less headache about our product development, because at the end we have a global fund who, is a mechanism of providing access to this. This is, in my opinion, missing in the NTDs, and I would really, ask to set up, or to ask the Global Fund to add NTDs in this, because there is such a difference for product development in malaria in contrast to NTDs, because we do not have this mechanism at the end. And the malaria patients also cannot pay for their product. So there are mechanisms, there are examples.
The panel want to address that? Yeah. Thank you. No, it is interesting to see why certain interventions and innovations come up addressing one field, like sleeping sickness, and what are really the opportunities and challenges to extend it into other disease areas. Yeah.
Just out of curiosity, very small scale, but in the sleeping sickness campaign, what we're really doing is using cattle as live bait. The cattle will attract the tsetse fly, and as it is sprayed, the tsetse fly dies in contact. We have just sponsored a smaller study in Kenya on malaria mosquitoes to see if the same way of treating cattle could also have an effect on malaria mosquitoes. That is, if you're spraying your cattle anyway, could that also impact on, and we will see the results come out sometime during this year, but we thought it was interesting as a spin-off to see if the technology could be transferred to another disease and another country, just to see.
You will know the Global Impact Investors Network. So one question is, what's the difference between impact investing and venture philanthropy, or is it complementary? And the very concrete question to both of you, and maybe Anne too, but you explained to me in the morning, what are you promising investors in terms of returns, in terms of recycling the capital, in terms of risks? I know it's a general question, but to get an idea.
No, I think they're excellent questions, and terminology, does matter, I think, personally, and it is very confusing still in this emerging field. I will say something about it, but before I do so, do any of you want to? Louise? Do you want to?
Did you want me to respond to both bits, or would you like to talk on venture philanthropy? My view on venture philanthropy is it's a kind of subset of impact investing. So impact investing covers a broader span, and venture philanthropy is part of that. But clearly I've got that wrong. So I'll leave that to Anne to talk further. In terms of your question around the investor case, we're still in a pilot phase at the moment, so we haven't pinned down the financials on the sleeping sickness DIB yet. When you look at social impact bonds in other sectors that have been developed in the UK, Canada, Australia, what you see, I think, is investment returns that are in the high single, low double digits in terms of IRR, so in terms of the effective annual return on investment, which I think is, they vary a lot depending on how they're structured, but when you look at the risk transfer, and I guess one of the things I should have said earlier in my presentation is impact bonds aren't bonds in the conventional sense. They don't offer a dividend that is fixed and predictable. They offer a return to investors that is contingent on the level of success that's delivered by the program. And when you look at that in detail around any specific impact bond contract, actually the risks look quite different. And you know, I would probably argue that at the moment the impact bonds that are being launched aren't pricing that risk at kind of market rates. And so we're looking really at socially motivated investors to come in to invest in them. So investors that see real benefit to, you know, the benefits of the structure in terms of aligning the interests and motivations of investors, government and service providers to deliver change.
You're not completely wrong, and terminology is fluid, but impact investing, as we traditionally know it, is finance first. Then you have social impact investing, which is probably more like venture philanthropy, because in venture philanthropy, it's societal impact first, and then you have sort of that sliding scale, and it's becoming an area where many people want to be today because it's a nice label. So I think the best way of finding out whether you are really a financial return first or a societal impact first is also to look a bit at the investors behind. Because from the investor you will see if they are a financial investor predominantly or if they are a sort of combined investor that is looking for both. So it is tricky.
Yeah, I guess from maybe just briefly on that, because I think it's important and there are no set industry definitions here. I think for me, and the way we talk about it internally in our organization to our companies, is what for me unites both venture philanthropy and impact investing is the way we go about things, which is really leveraging, as I said, these principles that do come out of the consulting industry, venture capital industry around how we do due diligence, the structure, how we invest, how we set milestones, how we monitor, etc., etc. So the approach is common, I think. I still like to think about venture philanthropy that ultimately, and we do both. Globally, venture philanthropy, we still give grants and donations, and we're quite happy to do that to organizations or interventions that are really can only work when they're not for profit, because there's just not a sustainable business model that can be wrapped around it to really aspire to have it ultimately turn a profit, and that's fine, and we give grants and donations. We use the same expertise, if you will, the same people, the same tools and everything. And then impact investing, I wouldn't say for us necessarily it's finance first, but yes, a lot of people would take that view. I think for us, everything we do is still always social impact first, but when we use the word investing, we're thinking about debt and equity, really not grants and donations. And what return we would aim for when we do impact investing really depends on who gives us the money. What we do globally, which is with the family's money, basically, which is ultimately a philanthropic pool of capital that they are interested in using differently than just giving grants and donations, not really to make a return. Part it's to make a return because then of course we can amplify and recycle that capital, but it's also driven by a belief that we can do different things and grow different organizations if we have this profit motive there. But ultimately we don't really aspire or need to make a return on these investments. We will aim for it, but over our portfolio, we don't plan to make a return on that. We might in individual investments. For the UK fund, which I briefly introduced on the other hand, where we've brought in other investors, that's not our money. There we did put a target return on the cover, if you will, of the fund of around 7% for the investors. So there we clearly need to blend both the social impact and the financial and aim to achieve that.
Hi, thank you. I come from the NGO world, and increasingly over the past decade or so, we rely on grants and donations. We have to prove our impact. And donors are using the language of venture philanthropy and impact investment. And the bars now, we are set extremely high. So I actually think that the gap between sort of charity in inverted commas and impact investment is closing. And in fact, the language used by DFID, by USAID, by Bill and Melinda Gates Foundation, they're talking about impact investment, return for their investments, et cetera, so I don't think there is actually quite such a huge gulf, both in terminology, but also in what people are expecting in return for their investments, whether it's charitable donation or not.
No, thank you for
Sorry,
that.
just a comment.
No, I think it's relevant. I think the two are converging. Are you looking for a comment?
No, that was just a...
Hi there, my name is Christina Rikers. I'm with Evidence Action. And one thing, we're actually starting to do some results-based financing, which I think what a lot of this is about is trying to align incentives towards results, both for the funder, donors, as well as for the service organizations. And I guess one question that I've struggled with is what is the right level of risk for us as a nonprofit to take on? Because I feel like with a lot of these things, any sort of results-based financing, the devil's really in the details. What is that right upfront payment, visa, and then the final payout? Because even if we have our own maybe bucket of unrestricted funding that we say we want to sit aside for this, I think it's a challenge for us to think through what that right balance is, even as we take on debt and other things. So I'd be interested in any advice that you have for nonprofits who are interested in setting some of these up. What are those things to keep in mind, particularly around that right risk ratio?
I don't have the perfect answer. I can just explain what we did when we set up. We had invested in the mass treatment $150,000. As we didn't get the sustainability, we felt that our money would be wasted in a way if we couldn't sort of invest maybe just a little more in protecting it. And in the case of providing the vets with startup financing, it was relatively small amounts. It was around $5,000–6,000 per vet on a very, very well worked through business plan. And we made it very, very clear for them that this was not a lifelong employment. This was a sink or swim, and that we would revisit after 6 months, 12 months, and the maximum was 18 months. Those that were sort of clearly on a path on 12 months, and we also put the financing that we gave them in a way self-liquidating. So it was diminishing month by month, forcing them also to sort of make up that gap. In a few cases, we gave them an additional few months because we were, sometimes it's the gut feeling that tells you they are on the right way. But we were also very clear that you get this extra lifeline, and if it doesn't work, it doesn't work. So I think it depends from time to time. We also try to reduce the risk by actually giving them 2 weeks training in business skills, because they were graduate vets from the veterinary faculty. They had no clue about inventory management, cash flow. So again, with that, we put that additional investment in to try to protect the first investment. So.
John Brand from Affect Hope. Actually, a Bitcoin question, if I can change direction a little bit. We're a Canadian organization. We accept Canadian funds, and any other international currencies are a little more challenging because banks take their cut, and you have to deal with the management of that. How does that work with Bitcoin in terms of, I saw the immediate transfer 1 to 0.27, I think it was, in Bitcoin. How much gets lost in the exchange, and if nothing, how do you survive if all you're doing is moving money for us into different currencies?
Bitpay charges 0 fees, and Bitcoin transactions cost no fees. Bitpay can still charge 0 fees because the company is funded by people like Richard Branson. We work with the freemium model, so we start with a 0 fee plan for people that just want to do transactions. If they want to accept Bitcoin as payment, it's free. But for example, in the future, we think more companies will start doing payrolling in Bitcoin. They need more integrations for that, and we sell that software. So now that's only happening in Silicon Valley with the most futuristic tech-savvy companies, but slowly it's increasing in other places. So The company was profitable for a very short time, then they started expanding pretty quick. And now we're looking for new developments, new ideas to, to sell, how do you say, implementing new technologies within the ecosystem of Bitcoin. So now it's all free, the transactions are free, and they will be free forever. This is just a small technology on top of the network, and exchanging it for a Canadian dollar is free. So $10 donation in Bitcoin will be a $10 on the bank account of the organization.
Another Bitcoin question. You mentioned when you started, oh, sorry, Niels, a question for you again. You mentioned that some people were still a little bit scared of Bitcoin, and I was wondering, as an organization who might be interested in receiving them, whether one should wait for the fear to kind of abate, and if not, if there was any foreseeable problem with that.
Well, right now I could understand that organizations don't want to hold or don't want to have Bitcoin as a currency. That's why we offer that we convert the Bitcoin right away into whatever currency the company is located. I think that's a first step, and it's a first step that shows that you're open into new new technology, and that gives a sign, a signal. It's not that you have to hold Bitcoin, that you have to understand the whole protocol, because most people don't understand how banks work, and that actually the money in your bank account is debt of someone else. And that's all very difficult. So maybe the first step is just accepting it and getting the group of the young people that are into these technical, futuristic ways of payment. If you only attract them, maybe they'll see you as an organization that they can level with. And that's the only thing that it starts with. Maybe in the future, there are some talks about decentralized giving, crowdfunding within Bitcoin. It's all new, and it's not happening yet. But there are ideas of a farmer in Ukraine, for example, after the war. Maybe he wants to buy goods again. He goes up to a website. He says, okay, I'm going to do this and this. I will post videos about my project, and everybody can fund him without banks that come in between. So the money will go right away into his wallet. He can buy whatever goods he needs, or whatever he needs for a farmer, to be a farmer or whatever. And in this way, wait a second. In this way, nobody comes in between. It's a straight line. Everybody can see online what's happening, what he is doing with the money. But it's a very decentralized way, and I think that's the future. It's not happening yet. It will take a couple of years, but the improvements and the integrations are going really quick right now. It's even hard for me to follow.
Daniel Rostrup from Thomson Reuters Foundation. I was wondering if some of the panelists could talk a little bit about crowdfunding and what the role of crowdfunding is in philanthropy, social investment, and so on.
Not really one for me, but any of you? Or
yeah. I mean, I think at a relatively small scale, I think there's a lot of interesting crowdfunding models, and I think actually as the social investment market matures, there are potentially very interesting models whereby you could potentially crowdfund within, say, a DIB structure for outcomes funding, as well as potentially crowdfunding investment. At this point, I think the structures are a little bit haven't got enough of a track record behind them. I think wouldn't, certainly from an investor perspective, be open to retail investment. But I think in terms of looking forward to the future, that could be a really interesting way to say, well, some people might want to pay for the results, other people might want to take a risk on paying for the services, and in the event that they might get a return on their money if it works. So I think there's a really interesting space emerging around crowdfunding for investment. Just picking up a little bit as well on the point that was made around risk and results-based financing for NGOs. I wondered whether I might add a couple of points to Anne's observations, where actually I think in thinking that through, there are a range of different pieces, not least, I think, yes, you're right, the financial considerations around what's your unrestricted funding versus the debt you're looking to take on, or the outcomes risk you're looking to take on. But I think also you would need to be thinking about what's your track record of delivering those programs? How confident are you can achieve the outcomes? And also, I think if you're looking at taking on any kind of risk, how closely is that program related to your mission? You know, if you're taking on any kind of risk as an organization, you really need to be, I think, comfortable that that's core to what you're trying to deliver as an organization. So I would say those three things are important considerations in that.
Are there other questions? I'm not sure. Are we okay in terms of time, Marion?
My time there, I'm not sure what time it is actually.
It's just 1:22.
It's lunchtime.
Any other burning questions, or is this a good time to wrap up?
I just wanted to comment. Oh, sorry.
I think about crowdfunding, it's done by young people a lot. And I hear all around myself, my own friends, that they join crowdfunding projects, and I think it's a very modern way. So I think it's good to look at, just like cryptocurrency, and it's good for traditional organizations to look at it and to start joining it, to open up to it, because it's a very transparent way of donating, and you can check online who is giving the highest return, for example, on websites. It promotes also for example, if you're an African entrepreneur and you want to build toilets, it promotes that they use the internet, that they use video to show what is going on, and well, within young communities, it's happening more and more right now, and so now it's still small, but as the years go by, it will get bigger and bigger because there will be more young people. So yeah, that's what I think.
I just wanted to add that crowdfunder were invited to participate in this panel actually, but they just felt that it was not for them. And some of the projects in NTDs, if you think about drug discovery and drug repurposing and so forth, are extremely costly, and a little crowd-funded project might not be suitable. So perhaps for certain things, yes, crowdfunding, but on a wider scale, maybe there's just not a great fit.
I was just going to add, I agree that, it has been smaller amounts so far. There's a great deal of transparency, but just a great deal of transparency doesn't in itself mean that you are impact-driven. So I think the two should not necessarily be confused.
No, it doesn't seem like it. So I'd like to thank you all for your contributions.